Welcome back, you guys. Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. And I am back from vacation. Had a really good time. This is the first live I've done in about 2 weeks. I actually left on vacation doing a live, put together a presentation. We went over about 16 things that I believe are impacting home values. But today I have some really good stuff to go over with you guys today. I think you're going to find it very helpful if you're like me on the sideline, or if you just kind of want to figure out exactly what's going on in the housing market, because we have a tremendous amount of factors kind of battling it out, with one another. So we'll go over that today. I'm going to take you guys through actually the history. I'm going to take you guys into the past, and we're going to look at case Shiller, and I'm going to show you guys that home values actually rebounded in 2006, 2009, and 2010, followed by obviously a decline, because we have something similar, I believe, happening like that today. Now, after case Shiller, y'all, I'm going to take you guys to a report, an economic research paper that the San Francisco Federal Reserve just came out with pertaining to excess savings. I believe, obviously, you guys, that what's fueling buying demand right now is the excess savings from, obviously COVID. So we're going to take a look at just how much excess savings is left. And you guys, I believe, are going to actually like what we read, because excess savings, y'all, is absolutely plummeting. Absolutely plummeting. So we're going to go over that. And then also I'm going to show you guys the other thing that's actually skyrocketing, which is cash out refinances. The reason I want to show you guys the data for cash out refinances is what it's really telling us is potentially homeowners are actually trading in their low interest rates to cash out, to get money out of their house, trading the low interest rate in for a high interest rate. So we're going to look at that, guys. Very interesting to point out that credit scores are actually much lower with cash out refinances, which is basically signaling that homeowners right now are hurt, right? Homeowners are potentially in distress. Now, after that data from Black Knight, I'm going to take you guys and we're going to read an article from Redfin that basically goes over their weekly housing market update. And I want to look at that data, you guys, because that information is bad. So before we get into that bad report, I'm going to take you guys through all this other stuff first, because you're not going to like what Redfin has in it, y'all. And also when I'm reading Redfin, we're going to act as if the Fed pivots. So, looking at Redfin article, what happens if the Fed pivots and lowers interest rates, right? So we'll look at that. Now, I'm also going to show you guys something that is very intriguing that I actually found out last night. And that is how closely, and listen to me, you guys, how closely unemployment and mortgage delinquencies track each other. Not quite like the 10-year treasury and mortgage interest rates, but they very much so closely track one another. It's actually really astonishing, because what do we have right now? What do we have? We have record low unemployment topped with record low mortgage delinquencies. So the really crazy thing is how closely that all matches, you guys. And that's what we're going to go into today. Again, we'll start with case Shiller. Everything is going to be chaptered if you want to come back here and reference it. But real quick, you guys, I just wanted to say, good morning to Jeff. Love you. Elijah, love you. Don't move, love you. WTH, love you from the very beginning. Melissa, definitely appreciate you. Again, don't move. Dental coverage, I love your screen name. I love all you guys so much. Deuster, obviously the man, appreciate you. Damien, just want to let you guys know that I definitely appreciate y'all very much. Steve-O, what's going on? Everyone here, MFH, good morning, everyone. Good morning. Don't move. Don't tip me, brother. I want you to save your money. I want you to, instead of tipping me, buy a coffee for someone. Except Cindy actually spent $40 on buying coffee for someone. I'm sorry about that, Cindy. Don't move to Texas. I really appreciate you. Now, before I jump into this data, I want to tell you guys about my past mistakes, and really about what happened to me, because you guys should know. Good morning, Vin. Christina, I see you. Scrog, I love all you guys. There's Cindy. I am blessed. You guys, I was thinking about y'all so much on vacation. There's just so much hate right now, you guys. As soon as the trends appear to be reversing, here comes the hate. Here comes the realtors, and it is overwhelming, you guys, because I'm kind of sometimes. Well, actually, a lot of the time, I'm sensitive, and I read all of the comments on my page, and I grow from them. So, anyways. That's neither here nor there. Let me tell you guys what happened to me back in 2009. Some of you that follow my channel understand that I personally, and I went through this whole process of recovery and rebound. I personally had a foreclosure, bankruptcy, repo. It was a volunteer repo and a tax lien in 2009. And that tax lien followed me around for about, I think about 9 or 11 years. I can't remember exactly, because I was not able to file insolvency. So I had to pay the deficiency of my foreclosure. So really, really bad, guys. And I wanted to talk a little bit more about what happened to me. Now, I was an industry professional. I got started in the industry back in 2002 when I was 18 years old. So I've been doing this since I was 18 years old. The first home that I flipped was actually in Irvine, California. It was a condo and I flipped it and made about $50,000 by the age of 20. And by the age of 22, I had owned one of my first primary residence, really overpriced house. But here's what I want to say, you guys. Basically, I think I purchased around 2006, I believe. So I purchased in 2006 a condo in Southern California. Okay. Now, what happened is I heard many reports about the housing market crashing. I heard it for 2 years. But I was a professional, you guys. And what I decided to do is keep my head in the sand and just keep working, right? I blinded myself to the reality of what was going on in the housing market. So when I think it was either the end of 2007 or possibly the beginning of 2008. At that time, I was suffering because I also owned a business, all right? I owned a mortgage company. And at that point, the mortgage business was going down greatly. So I was having trouble paying my bills. And my overhead at the time was $35,000. What 23-year-old is going to have that? I was 23 with an overhead of $35,000. Okay, so the first problem right there. But the thing is, guys, I kept my head in the sand, and I decided at the end of 07, beginning of 08, to refinance, cash out on my house. So what I did is I did a refinance, and back then I can go 100% loan to value, which means I can squeeze all of the equity out of my house back in the day. In Texas, the cap is actually 80%. Very interesting. So, around that time, I cash out, refinance. I think I pulled out I think it was like $80,000 or $90,000. And what I did with that money, y'all, is I paid the IRS. Okay. I paid the IRS. So the reason I'm telling you that is I was a struggling homeowner and I didn't even realize it. I didn't even realize the housing market was crashing until I lost everything. Okay. Because I was so focused on surviving and making money, I completely turned away from caution and remained overly optimistic, refinanced, pulled out all my money, paid the IRS off and said, you know what? That's good. What I should have done is things a lot different. But anyways, guys, when I stopped making money, and essentially what happened is all of the mortgage lenders went out of business. Everyone started buying everyone, and the business completely died. And when I refinanced my house, I got my mortgage payment up to $5,000 a month. Again, age of 23, just my mortgage payment, $5,000 a month. I could no longer afford to make my mortgage payment. Okay. Now, I didn't expect to have my job lost, right? When I purchased it, I just wanted my own primary residence. I was proud of myself, but I lost the house, you guys. And instead of staying in that house when I couldn't afford it, I just left. I could have stayed in my house probably for 2 years to go through the loan modification process, but I was so discouraged and disappointed in myself. I left after about 2 weeks. I literally abandoned my house after 2 weeks. And honestly, you guys, the foreclosure, the bankruptcy, and the repo that followed that, it ruined my life for about 9 years, okay? Because on top of the foreclosure, I also had to go bankrupt because I was drowning in consumer debt, like credit card debt, car loans, and things of that nature. So not only could I not pay my mortgage, I also was drowning in debt. And I believe that similar patterns are happening right now with consumers and with homeowners. So I'm going to paint that picture for you guys today. We'll go over that today, and it will make more sense as we move along. But where I'm going to start, you guys, I'm going to start with Case Shiller. Let me do a timestamp real quick. And I want to show you guys that back in the past, back during the last great financial crisis, home values actually rebounded as well before going down greatly. And the reason I want to say that is home prices, home values are rebounding the start of this year. Okay, they are rebounding, but I don't want people to automatically think just because in most areas home prices are rebounding that has somehow canceled the crash or that has somehow indicated the bottom of our housing market. To say that, in my opinion, is naive and even negligent because why? We're still on this path. Okay, we haven't stopped quantitative tightening. We haven't even got through a recession yet. We don't even have the unemployment yet. So to say that before the ride has even ended, y'all, it's just, I don't think it's a good idea. So I'm going to bring up this chart right here. Let me show you guys real quick. Okay. Now, this is a chart form of Case-Shiller. Now, Case-Shiller basically comes up with value. This isn't median sales price. This is Case-Shiller value. Okay. And what I want to point out to you guys, this is going back to the year of 2000 on over to current year to date. Okay. And you guys can see up here, let me turn on my pen real quick. I'm sorry about that, you guys. All right, so you can see up here, it goes to, you guys see that? It goes to the year of 2000. But here's what I want to point out. The decline in home prices the last time around, you guys, so that you understand how these things work, okay? Personally, I didn't expect excess savings to be so powerful. I think it's so powerful because the Federal Reserve bailed out banks, but I'll get to that later. But anyways, guys, the decline started here. Okay, in 2006. So home price decline started in 2006. You guys see that right here? Okay. This is Case-Shiller. I just want to make this point. This is very important. So for 1, 2, 3, 4, 5 months during 2006, home values, according to Case-Shiller, it's a very respected value generator, right? It's very lagging as well. But home values went down for 5 months straight in 2006. And look at what happened here, you guys, in September. Okay, so in September of 2006, home value rebounded right here. I'll circle it, and right here. So proceeding like an absolute gutting of values, I want to say this, home value rebounded for 6 months before a catastrophe happened, okay? And as you guys can see, okay, right here, March 2007, look at all of those months of straight decline after March of 2007, okay? So again, warning signs in 2006. I myself chose to disregard the warning signs and I lost everything. So I'm just saying, maybe right now we should look at history, be a little bit of cautious. I know our emotions are high. I know everyone's frustrated, but for the love of God, please understand that these things happen, okay? Things take time. I don't have all the right answers, but I am showing you historically in 2006, home values started the decline, okay, for 5 months. And then shockingly, they rebounded for 6 months before a massive gutting. Okay? Because a lot of people are saying, oh, it's rebounded, we hit bottom, you missed out your opportunity. And the reality is that's false. But look at this. I'm going to circle this as well. I'm going to pick a different color. Let's go with red. All right. Now, home values also rebounded right here. Okay. Do you see this? 2009 twice. So again, during the biggest financial collapse and home value collapse, home values rebounded 3 months in 2009. It rebounded in June, July, and November. Okay. So again, 2009, same thing happened, but look at what happened after November of 2009. Okay. So starting right here, all of this decline. And then look at right here. Oh, the market's okay. So in 2010, home value also appeared to rebound in 2010. However, if people bought in 2010, we're at the bottom, yeah, hurrah, hurrah. Home values went down for another 2 years. Do y'all see that? So after 2010, in April, we had another 2 years of property decline. And again, this is what I'm saying. Here's the point I'm really trying to make here, you guys. We can't just assume just because home prices appear to be at the bottom or rebounding, we can't assume that this whole show is over, okay? If you don't even want to pay attention to the Federal Reserve and the quantitative tightening and all of these things, which you guys should pay attention to. I mean, you guys look at the past, okay? So no one right now can say we hit bottom, house prices are rebounding again, because we don't have enough time that has passed after quantitative tightening, after the recession. We need the whole blueprint, okay? So I'm just saying, y'all. I'm just saying. Now I'm trying to pull up this real quick. So, anyways, you guys, I'm going to show you guys this now. All right, let me change my camera angles to this right here. Let me turn this camera on. I'm really sorry about that. Okay, you guys, I didn't even have that camera on. So I'm going to show you something that's also really cool. Now, let me show you guys, this is what I want to talk. Also, do you guys see the DeLorean up there? Do y'all see that? Do y'all like the DeLorean? Because we're going back to the future, y'all. I need to take you guys back to the future so that we can settle down a little bit. But what I want to show you, okay, I'm going to bring up case Shiller, and I'm going to show you during 2009 to about 2012 that seasonality, similar to what we have right now, that seasonality actually played a role in home value. So during, again, 09 to 2010, there were times where home value went up, but overall from 09 to 2012, the decline was downward. The reason I'm telling you guys that is we may have something similar happening right now to where, during the hot months, real estate value goes up slightly, but during the slow months, it goes down much sharper than when it went up. Okay, so the overall trajectory is a downward trajectory with seasonal influxes in value. That's what happened last time. Let me show you guys right now. Okay, let me pull this up. Take a look at this. Okay, I'm going to zoom in here. This is, again, the case Shiller. This is by Fred now. Now I'm going to zoom in here, and I want to point out that this is starting about 2009 to about 2010. And I'm going to zoom in here, you guys, okay, because I really want to hit home on this. All right, now this is home value. Okay, this is home value. Now where these red arrows are pointing is, look at, this indicates an increase in value. Okay, followed by what? A sharper decrease. Slight increase up again, sharper decrease. Slight increase up again, sharper decrease. So I believe it's very, very possible we see something similar going on right now where we have this increase followed by a sharper decrease for a period of who knows how long, 3, 4, 5 years, who knows. But I do want to point out, you guys, as of 2009, seasonality did play a role in home values. But again, you guys pay attention to this. The overall trend was downward. And let me show you that here. Okay. So again, even though we had increased value here, if you look from when it went up right here, so it went up right here in 2009, but overall, you guys, you can see it did head downward. And what that means is people that were not prepared or even lost their job got trapped. And also what I want to point out is this. So 2009 home value rebounded. People are like, okay, let's go. It's gone down. It's time to buy again. But look at how long it took to recover. Okay, take a look at this. 3 years. Look at that. It took 3 years to recover. If you thought the housing market rebounded in 2009 and you were part of those buyers that are like, yeah, we're going to get a great deal, understand that you didn't even have an increase in equity for 3 years, meaning you were trapped in your house for a minimum of 3 years. Do y'all see that? So again, three years. Okay, and here's what I'm really trying to say, y'all. All right, this is all I'm trying to say. Let me get this down here. Be cautious. That's really what I'm trying to say. I have to share my screen real quick, you guys. I'm going to present. I'm going to stop sharing. So, let me know how you guys feel about that. I think it's incredibly important myself. We're going to move on to excess savings, y'all. But let me get there in a minute. So I just want to reiterate a couple things. I had to set this up. I'm so sorry. I had to do the same thing over here. Housing market. Okay, boom. Now, first of all, case Shiller showed reversal in 2006, 2009, and 2010, even though home prices continue to go down to 2012. And again, look at that historic pattern. It's very, very possible something similar to that is happening right now. So again, seasonality does come into play. Now, here's the thing. Again, the rebound doesn't mean the housing market is crashing. What I believe is happening right now is, we got to ask ourselves, what is fueling buying right now? Okay. What is the catalyst? Because pretty much everyone knows that mortgage payments are like insanely high right now. Okay. Unaffordability is like super shockingly high. So when I really meditate on this and think about, okay, comparing last year to this year, the two conclusions I have is excess savings right now is fueling home buying. And excess savings is like giving a consumer a loaded gun and they just can't wait to shoot it. They only got one bullet. But when consumers have loaded guns, they're going to shoot, okay? They're just going to shoot something and they're going to settle on that. And that's what I believe excess savings is. Now, I asked myself this. Well, we had excess savings the end of last year. So why did home values go down last year when we had even more excess savings? And here's my conclusion on that, you guys. And here's what I really pinned down and hammered home. I personally noticed a substantial change in sentiment and buying activity immediately, almost a snap of the fingers after the banks got bailed out. After the banks got bailed out, y'all, I noticed a huge change with consumer spending, quite frankly. And obviously that's when tax returns come into play. But the fact that they did quantitative easing, I think that messed up a lot of people's mind. And think about this. The government, Federal Reserve, right now is doing quantitative easing for the elites, but they're doing quantitative tightening to the consumers. How's that fair? How's that fair? I'm just saying, how's that fair? But anyways, now having said that, we're going to go into excess savings. Now, this research paper is from the Federal Reserve Bank of San Francisco. This was published less than a week ago. And I think it's really, again, you guys, listen to me. I think we really need to pay attention to the excess savings because we have never had a situation like we have now with so much excess savings. And most everyone knows that consumers are propping this whole thing up, along with the government, obviously, along with the government. But let's take a look at this, guys. I think you guys are going to really like it. Let me make a timestamp right now for excess savings. Okay. Really good paper here. And I will have this link, you guys. I will have this link. Again, this is from the Federal Reserve of San Francisco, okay? The name of this report is The Rise and Fall, and this is the good news. This is what you're going to like. We're going to really talk about how much excess savings is gone. And when I read this, I was like, oh my God, thank goodness, thank goodness. Because I heard mixed reports. Like I even heard some people saying excess savings was going up. So when I read this, I was like, yes, this is way better than I thought. Anyways, but let's read this. The rise and fall of pandemic excess savings. So the first little paragraph is a little bit of a summary, and this is what it states. U.S. households build up savings at an unprecedented rate following the strong fiscal response and on top of that, lower consumer spending related to the pandemic, obviously lockdowns. Despite recent rapid, drawdowns of those funds, estimates suggest a substantial stock of excess savings remains in the aggregate economy. Now, this has been happening since 2020. Households across all income levels have held a historically large share of savings. And here's the important thing to understand, okay? It's not equity. We're talking about like liquidity of savings in cash or other accessible forms. Because I was talking to Jeff M yesterday, and he's like, Travis, does this include equity or where does this include? So this is like liquid assets, right, are easily accessible, okay? Now, estimates suggest that those funds could be available to support personal spending at least into Q4 of 2023. And to me, you guys, listen, this is great news. So they're basically, this first paragraph is they're probably going to run out this year. That's good news because I heard reports that said that we're going to be at 35% by year end. So this is saying we're going to be at 0 by year end. Okay, so let me read a little bit more of this. Incredibly powerful stuff here. Let's go into exactly how much money, though, the government pumped into the economy during COVID. This is very interesting. The fiscal response on the onset of the pandemic was swift and significant. Between 2020 and 2021, the federal government launched several stimulus packages, and here's the number, that injected about $5 trillion into the U.S. economy at a time when many people had seen their household incomes dwindle, okay? That's a lot of money. That's a lot of money. I mean, do y'all agree with me? I can't even fathom $1 trillion. Can y'all fathom $1 trillion? I can't. Oh, yes, Alyssa, I see that. And part of that money was PPP and EIDL, which was a payroll protection program and the economic injury disaster loan. And a lot of people, a lot of businesses, and this, in my opinion, is part of the reason why we have that hot labor market, the PPP and the EIDL. Small businesses have a tremendous amount of money as well. But if you look here at this chart, you can really see how much money comparatively they pumped into our economy, it's shocking. It's absolutely shocking, you guys. They pumped in so much money. Now, here's what I find interesting. Here's the aggregate personal savings versus pre-pandemic trend. Basically, everything in green here is the massive influx of excess savings. Okay, so accumulated excess savings, 2.1 trillion. But look at you guys, about beginning of 2022, that excess savings has been dwindling at an unprecedented rate, which again would explain inflation. Okay, the housing market rebounding, because it's like a loaded gun. When you put money in a consumer's hands, what are they going to do? Most people are going to spend, right? And how does our economy work? It works in people spending money, accumulating debt. All right, but again, let's look a little bit more into this, because great news, you guys. Now, this dynamic in excess savings associated with the pandemic period is unlike any past recessions. And that's why this thing is so hard to call. We have never had a potential recession or an incoming recession, but yet excess savings is through the roof and unemployment is at historical lows. Really, really crazy stuff here. But let me go down to the conclusion, because you guys are going to like this. Again, if you want to read this in more detail, you guys can do that. But I'm going to give you guys basically the meat and potatoes here. And here's the conclusion, and this is actually great news. U.S. households accumulated excess savings at an unprecedented speed following the onset of the pandemic relative to the other post-1970 recessions. Here's the beautiful thing. Despite recent rapid drawdowns of those savings, a large amount, around $500 billion, remains in the overall economy. What does that mean? Okay, again, the last report I read said we're going to be at 35% by year end. What this means, guys, okay, so we start at 2.1 trillion. We now have 500 billion. This means we have less than 25% of excess savings left. Did y'all know that? We only have to, y'all, I was like, thank God. Right. When I read this, I was like, oh my God. Well, it's also a horrible thing, because it also means that people are just burning a hole in their pocket, whether it be to keep up with unaffordability or whether it be wasteful spending. Either way, people are spending money at an unprecedented rate. We see that in all the information. But again, did y'all know that? We only have 500 billion left in excess savings. That's it. Only 5. So we got to get rid of the excess savings. Let's continue. A great deal of uncertainty surrounds precisely how the savings are distributed across household income levels. So basically, this is saying that the poor people already have no savings, and like the rich people have most of the savings. Very interesting. Now, listen to this conclusion. This is important. This is what matters to us, okay? Overall, we expect the aggregate stock of excess savings will continue to support consumer spending at least into the fourth quarter of 2023. So they're saying that consumers are going to be spending into the fourth quarter of 2023, potentially propping up certain markets, and then it's done. And then what happens, guys? When we take out this, here's the thing, you guys. Let me ask you this question, okay? When we take out the excess, when we take the cash, the liquid cash out of the consumer's hands, what happens? What happens? In my mind, this is the leading catalyst for purchasing. I understand also we have limited supply. I understand we have seasonal trends, okay? But we had limited supply and seasonal trends last year, all right? So again, I really believe that factor is that excess savings, but also because we had excess savings last year, I really think, y'all, I think it was that bank bailout. I think it was that bank bailout that messed people up. And just to put things in perspective to you guys, the Federal Reserve, or the discount window, has already traded up over $800 billion. That exceeds the last financial collapse and the bank bailouts of 08 and 09. Right now, it exceeds it by I think by about double, almost triple. And they say it's not quantitative easing because we're consumers. They don't want to hurt our feelings, but it's absolutely quantitative easing for the elites. And injecting $800 billion in money to lenders, that's going to create a problem. And here, let me ask you guys this, and please comment below. If the federal government, the Federal Reserve, let the banks collapse, wouldn't we have even tighter credit restrictions? Wouldn't we have even more unemployment? Wouldn't the sentiment be even lower? Yeah, it would. So this whole narrative, oh, credit's going to tighten, don't worry. I want to see more credit tightening, because the reality is by bailing out those banks, they loosened up credit once again. It would be way worse if they would have just let them fall apart. It is what it is, whether you agree or not. It's just my opinion. So that's the excess savings. savings. That's the excess savings, y'all. I want to show you guys something that's really, really cool now. I'm going to show you this right here. I appreciate you. Let me do my next timestamp. You guys, I think I'm making some good time here. I don't know. I hope I am. All right, let me put this up here for you guys. Take a look at this. All right. Here's a reality of situation. Okay, this is crazy. It's something crazy. I got to access it, but something like, I think it's like 70% of the mortgages have rates under 4%. Y'all hear me? That doesn't help us. Okay, the fact that over 70% of mortgage holders have a rate under 4% does not help us on the sideline, right? It's going to be harder for those people to want to move. But this is what I have said, and the point I've been trying to make is homeowners are in distress, just like everyone else. Maybe even some homeowners are even in more distress. And we will see homeowners cashing in. And now I was saying that they're going to cash in by selling, but what we're seeing right now is homeowners cashing in the form of refinance. So now that they've taken out most of their equity, what's next? Selling. That's what's next. When you take out all the equity, because why would people take out the equity through a cash out refinance? Well, you could say investors, right? But investor demand is crushed. But a lot of people take cash out refinances to pay off their debt. Okay, that's what's happening right now. People are paying off their debt. And I want to show you guys this because this is really intriguing to me. I want to show you guys the credit scores. So the credit score, okay, first of all, this blue line right here, you guys see how this blue line has plummeted down right here? That blue line represents cash out refinances as it pertains to credit scores. So we can see that towards first quarter of 2022, people started refinancing, cashing out, and their credit scores started plummeting. Do you see that? The other average credit scores are up here. Also, rate and term actually went down a little bit, but cash out refinances have plummeted. The average credit score is now a tier of 680. Okay. The average credit tier for a purchase is 720. So they've lost they've gone down 3 tiers of pricing on LLPAs anyways, the fees that I've been trying to explain to you guys, the bite-in tax thing, those are LLPAs. This pertains to LLPAs. But you guys, to me, what this blue line is signaling to us is the condition of current homeowners. Okay. The condition of current homeowners. If cash out refinances are exploding, and the credit scores that the average credit score to get those cash out refinances is plunging, that means that consumers are suffering and that they need money. And by doing that, here's the astonishing thing. By people cashing out and refinancing, what happens, y'all? And I'm talking about an actual cash out refinance. Okay. I'm not talking about a HELOC or something of that nature. If they get a cash out refinance, they have to take the high interest rate. They trade in their 3-4% interest rate for 6 or 7% interest rate. And why on earth would people want to do that? Well, what if they're drowning in debt? What if they're drowning in debt and can't catch up and they need $100,000 so that they could continue to struggle on? And that's exactly what I did in 2008. I was struggling and I did 100% cash out refinancing on my house because I wanted to catch up without selling my house. Unfortunately, that was one of the worst decisions I could have made in my life. All right, I'm just saying. And it appears the same thing's happening here. And just to put it in perspective, let me pull this up for you. So the share of refinance is 13%. So 13% of mortgages right now are people refinancing more than likely into a higher interest rate. Just saying, you guys, more than likely into a higher interest rate. That's what the data shows me. Does it not show that to y'all? Be honest, does it not show it to y'all? Now, take a look at this. Okay. Y'all tracking with me so far? Okay. So we're seeing consumer homeowners appear to be suffering, right? But take a look at this. I'm going to put my next timestamp on here. This is going to blow y'all's mind. It blew my mind. Okay. I'm going to show you guys. This is crazy. This is from the Mortgage Bankers Association. This was late last night. I sent it to Jeff M. Okay. Jeff M's my anchor. Show Jeff M some love, y'all. And you know what? I'm going to give Jeff props because I've been leaning on Jeff. Because again, you guys, I had to go on vacation. I was so upset at what was going on with consumers in the Federal Reserve as far as the bank bailouts. I just needed to leave and also reflect because the home prices rebounded. I was like, what's going on here? But I'm going to show you guys the relationship with unemployment and mortgage delinquencies. Take a look at this, y'all. Let me pull this up real quick. Look at this. Okay, again, this is their chart of the week. So Mortgage Bankers Association chart of the week right here. And this is amazing. This is so amazing. So the blue line represents mortgage delinquencies. Okay, I don't know if that's gold or I don't know what color, brown, gold, orange. I don't know. The orange, brown, gold line represents unemployment. Okay, y'all, this is insane. Look at how closely we track. Look at this. This is absolutely insane. And really, right here, post 1999, unemployment and mortgage delinquencies, unbelievable how close they track. Look at this. They are almost identical. Almost like it's not, but I'm saying it's similar to like the 10-year treasury and 30-year fixed rate mortgages, right? Having that direct relationship. This is very similar. Did y'all know that? So if y'all want to keep your eye on like foreclosures and mortgage delinquencies, what do we need to be watching? Well, I would argue on affordability, right? Obviously on affordability. We also need to be watching the unemployment rate. Isn't that insane to you guys? Look at, so when the unemployment rate goes up, so does mortgage delinquencies. When the unemployment rate goes down, so does mortgage delinquencies. And look, it spiked here in 2006, went down from 2010 all the way to 2020, went up in 20. Look at this. This is absolutely shocking to me how closely those resemble each other, how close they track each other. Maybe you guys disagree, but again, the reason I'm bringing this up, okay, just to make a point here, y'all. The reason I'm bringing that up specifically is so that y'all know what to watch, right? There's so many people yelling, it's time to buy, it's not time to buy. Oh, they're crash bros. Oh, the toxic cheerleaders. Like, I just want to drown all that out. Like, I don't even care anymore. I just want to find a house for my family and I want to make a great decision. And I've told you guys what I plan on doing, and I'm sitting at the housing market. Now, even though I'm sitting at the housing market, make no mistake, I'm still looking every single day, and I'm looking for a great deal. If I find a great deal tomorrow, I'm buying. Okay. And why would I buy tomorrow if I find a great deal? Because I know what a great deal is, just like you. So I don't think that like 100% we shouldn't buy right now. I think there's still that 1 in 1,000, maybe 1 in 10,000 listings that is actually a great deal. The other concern is this: what if 2 years from now, a great deal today isn't a great deal 2 years from now? And that has to do with like all of the dust in the air. We really don't know what's going on. So anyways, you guys, now here, before I get into the Redfin housing market update, and I told you guys you're not going to like it. Okay, I'm going to get to that in a minute. I want to say this. So I have people, I was going to bring up some comments, but we're kind of running long here. But I have a lot of people that are like, basically, essentially, oh, you're wrong, Travis. You're going to get the views. You should just buy now if you can afford it, right? Just buy now. Interest rates are just going to be higher. You could just refinance later, right? A lot of people say that, okay? Now, if you want to buy into that, by all means, and I told Jeff this, and he's like, okay, I get it, Travis. By all means, go buy a house right now, okay? I don't want to make the decisions for you. I don't want to be attacked for your decisions. If you want to go buy a house right now, just go buy a house right now. And just let us know how it goes. And by doing so, you're going to join your peers. If you're a millennial first-time home buyer, you're going to join your peers of over 80% of people that purchased this year that have buyer's regret. So here's the thing, if you don't listen to me, all right, and if you're just listening to toxic realtors, I would encourage you to at least take into consideration what any millennial first-time home buyer has to say about the purchasing process. Over 80% of those home buyers this year have regret. Think about it. What does that indicate to us, y'all? Red flag. To me, this is all red flags. Okay, look, here's the article right here. Over 80% of millennials regret buying first home in 2023. Okay, so again, by all means, everyone, go join your peers here. Go join this buyer's regret. Chain yourself to your house, right? You'll be fine as long as you could, right? 7 to 10 years. If you want to be dragging yourself around for 7 to 10 years and join these people, by all means. But my point is this. At the end of the day, each and every one of us is responsible for our own decision making. I'm just a normal person. Yeah, I'm a realtor, loan officer, all these types of things. But at the end of the day, I don't know everything. And your situation is different than mine. My housing market and my preferences in purchasing is different than yours. So what should we be doing? We should be asking ourselves, what is our goal, right? And should we rush the process of buying a house? I'm saying no. All right. Now, here's the thing, y'all. Here's the thing, you guys. Okay. Now that I've prepared you guys and we did a really nice, I feel like that was a pretty good deep dive. Do y'all agree? Was that a decent deep dive? Can y'all let me know? Because I have to drink this real quick. Yep. Okay. So, hit the like button, you guys. Thank you. Thank you. Hit the like button. I see everyone, the deep. Paul, Cindy, Irma, Nathan. Appreciate y'all so much. We're gonna go into Redfin, you guys. And the thing with Redfin, again, we're not gonna hide the data. The data is the data. We're gonna talk about the data. So I'm gonna read this, and we're gonna go over the charts as well, you guys. And this will be fast, and then we'll, like I said, we'll wrap this up. I'm gonna try to get to some Q&A as well with everyone. Maybe I could do a little bit of Q&A as long as we have enough time. All right. So I'm gonna pull. Oh, darn it. Fortunately, I don't think I can use this on my tablet. So I guess I'm not going to be able to do this on my tablet. That's all right. I'm going to come back over here. All right. So we're going to dig into Redfin right now. I'm going to put our timestamp. You guys, thank you for hanging out with me. I really appreciate it. You have no idea. You have no idea how much I appreciate all of you. I appreciate all of you. Even the haters, sometimes I appreciate them. Some of the haters have good points that I stop to think about, like, all right, what's their point? Right. So they actually help get me stronger. But anyways, guys, let's read this. Okay, don't forget to like it. Don't forget to like it. Let's see here. Yeah. Okay. All right. I was just reading something. I'm so sorry. I appreciate you, Christina. I appreciate you. All right. Here's the article. Okay. Don't shoot the messenger. This sucks, but I really, really want to just read this with you guys. And let's ask ourselves, what happens if the Fed pivots? What happens if they don't pivot? Now, the name of this Redfin article is Housing Market Update. It's hot and it's cold. Limited listings lead to few but fast home sales. Okay. Here's how this goes. Some cool, good points here. Okay. Fewer homes are selling than usual this spring. That is a fact. A lot fewer homes. In fact, I'm not referencing it in this video, but inventory only went up about 1,000 units. Normally from March to April, the units go up from 40 to 50,000. So it is a fact that we had a lot less inventory hit the market. And that's a fact, you guys. Now, this week's inflation report, which shows slow but steady progress, does it, on easing price gains, confirms it's likely the Fed will pause on interest rate hikes next month. Do y'all think that's going to be a good idea? Do y'all think interest rate hikes are going to be a good idea? Let's keep reading. So y'all understand what's happening in the housing market right now, okay? Limited inventory and elevated mortgage rates continue to suppress U.S. home sales as we enter the heart of spring. Now, typically a hot home buying season. That's the seasonal trends. This week's inflation report shows a slight, very tiny, okay, slowdown in price gains, confirming that mortgage rates are likely to stay about where they are for the next several months. That's because the Fed's interest rate hikes are working as intended to ease inflation, although slow. That means they'll probably won't hike or cut interest rates at the next meeting in June. And here's what I'm saying. That's completely ridiculous, because I'm not focusing on eggs. I know I should probably focus on eggs and bacon, but I'm focusing on the housing market, right? That is a massive. First of all, CPI shelter 40%, CPI roughly, okay? The GDP 19%, housing market. It's huge. I'm looking at the housing market. What's also important to note about the housing market, almost the stickiest inflation of all inflations. So it is hardest to control the inflation in the housing market than in almost any other sector, okay? So we have a reverse in value, and the interest rates going up are working. Maybe they would be working, y'all. And honestly, I do think that would be working if we didn't have the excess savings. All right. Just saying. We'll go into the details here. This is really intriguing stuff. But despite the inventory crunch, pending sales have increased over the last I was looking at my timestamp, over the last week, as they typically do this time of year. Additionally, mortgage purchase applications are up 5% seasonally adjusted. Take a look at this. Now, here's our leading indicators. So this is week over week leading indicators. Really interesting. So look at the daily average is always 6.5%, it seems like. Am I wrong here? Right? Everyone's like, the interest rates are skyrocketing. They're sinking. It's like the whole time it's been 6.2 to 6.8. and then like little fluctuations up and down. Insane. Here's what's interesting. Mortgage purchase applications up 5% from a week earlier. But even though it appears, like I said, people are flooding back into the market, they are flooding back into the market, that's still down 32% year over year. I want to make a point, if I may. And think about this, okay? This is insane. Think about the share of buyers right now. We have so much data now that investor demand is slaughtered. I don't care what anyone says, right? I'm going off of like, okay, first of all, the number one institutional investor for SFR rentals, I think it was Innovation Homes. They're selling more real estate than they're buying. So to the haters, what do they know that you don't? See what I'm saying? Okay. Anyways, so investor demand has been crushed, which means more than likely the buyers right now are the first-time home buyers that are well qualified. Because investors don't want to make the same mistake that the consumers are making right now. Think about it. Think about that. Just saying, it's the first-time home buyers that are biting the bullet, in my opinion. We just looked at buyer's remorse over 80. It was like 83%. The people that are biting the bullet right now, it's not institutional investors. They've got out of the housing market, a lot of them. It's the first-time home buyers. They're getting slaughtered. Anyways, that's the point I wanted to make. I'm going to keep going. Now, home buying demand, this is insane. Okay, so through all of this, home buying demand is only down 2% from a year earlier. Wow, right? It's only down 2% from a year earlier. Now look at this. Google searches down only 15%, but look at this. Touring activity is up, y'all. Touring activity is up 14% year over year. Wow. Touring activity is higher now than this time last year. Wow, y'all. Wow. Is that not bad news? Is that not bad news if you want a balanced housing market? It's 14% high. That means that people are falling apart. That means that patience, y'all, really is a virtue. Patience is really a virtue. Let's keep going. This is what I don't like to see. I really don't like to see this. The median home sales price was $370,000. Now that's down 2.7% from a year earlier. That's the 11th straight 4-week period of decline. So why am I not happy? Why am I not happy, you guys? We can show all of these haters like, oh, if you bought last year, most people are upside down in their house. We can prove that with the data right now. We can prove it. So why am I not happy? Okay. Why am I not happy? The reason I'm not happy is because median sales price is still going up. That's why I'm not happy. And because remember, you guys, if you've been watching my channel long enough, you know that we don't go off of year over year. If we go off of year over year, we're going to miss what's happening right now. We go off of week over week, month over month, even YTD. So in my opinion, year over year is not really going to help us, but it is down. It's down 2.7%. But not only that, listen, okay, this next bullet point. In 60% of the biggest metro areas, there's home price decline year over year. That means in 60% of the top metro areas, if you purchased on average, if you purchased last year, you're upside down in your house. It's probably more than that because how much does it cost to sell your house, y'all? About 8%. So even if they have the same value, they need 8% increase, more than that because of LTV, right? They don't get the full, 100%. They need 8% equity growth. They need 8% equity growth to even sell their house. Interesting. Look at this though, you guys. This is crazy. The biggest drops in Austin. So again, the housing market's not crashing. I need some hater to explain Austin. 17% is a crash. I've defined 15% from peak to trough as the start of a crash. Austin's crashing. Oakland down 15%. Oakland's crashing for different reasons. Las Vegas down 10.7%. San Jose 9.7%. And what's interesting is when we really analyze why they're dropping, it's intriguing that they're dropping for different reasons. This entire economy. Look at this. Johnny, I see you online. Here's Johnny. This guy right here, yeah, I really love Johnny. He is so cool. Y'all, he made me hats. He made me real estate mindset hats. Johnny, I love you. I love your sassy trolling, Johnny. I really do. I just want to give you a shout out, brother, and thank you for all those hats. And let me show you guys my boy. This is my boy right here. See Jeff? Jeff, tell him how much we talk. How much did we talk yesterday? How much do we always talk? I mean, anytime there's an article, anytime an update, Jeff and I are going back and forth. Y'all, I'm just a normal. Y'all hear me say I'm just a normal person. I'm just like you guys. I'm a consumer too. Jeff is my man. Jeff is my anchor. He's in St. Louis. Anyways, let me hide that. Sorry, Jeff. I'm start getting emotional. Look at this. This is insane. You know what? Let me start here. I'm going to start I'm going to start on the bottom because this is insane. Okay. So we have all of these like reversing trends, right? I must have skipped it. Look, no. Where is it? I didn't like that lesson. Where is it? Here we go. Okay. Jeff, I see you. Now, pay attention to me, please, guys. Pay attention to what I'm saying. This is why I'm saying that excess savings is feeling buying. Excess savings is feeling buying, topped with fear of missing out. Where did the fear of missing out come from? Bailing out the banks, in my opinion, okay? All of this is happening in the face of mortgage payments that are astronomically, historically, never before been even close to as high as they are right now. Look at this chart. The average mortgage payment is $2,566. And if I may, please, you guys, if I may, let's go back into, see the DeLorean? See that? See that DeLorean? Let's go back into the future. Let's go back into the future for a second here, just so that I can remind people what things are supposed to be like. That gray line down there, okay, by my face, sorry, that gray line down there represents 2020. In 2020, this is 3 years ago. I want you guys to think about this for a second here. Just 3 years ago, and by the way, we went through lockdowns and COVID, which I would argue those are like canceled years. Like, let's just remove those years from the space-time continuum because it's like a blur. Like, it was just all messed up. But 2020, okay, this time of year, mortgage payments were roughly $1,400. Say high $1,400, but they were under $1,500. 3 years ago, the average mortgage payment was under $1,500, which means that mortgage payments for the average person in just 3 years are over $1,000 higher, with clear signs of distress. And pretty much every realtor is saying that, oh, just hold for 7 or 10 years. Okay, well, you're going to hold for 7 or 10 years with potentially the highest mortgage payment on record. And here's another thing. A lot of people, and I talked to Jeff on this, he's like, some people want to put their liquidity in a tangible asset like a home. And I'm like, Jeff, the problem with a tangible asset being a home is it comes with an insane mortgage. It comes with a $3,000 mortgage payment. It's not a true asset right now. Now, 10 years from now, it probably will be. But my thing is can most people make it that long? Now, let's go to the beginning of this. I don't know if that's without escrow. That's a good question. I would have to go in. I can't remember. Now, listen, guys. Okay, so we're going to start here. Median sales price. Here's what's really alarming. Look at the spike upward. Now, this is just week to week. Obviously, we need more than just week to week trajectory for a trend to form. But it's easy to see here that a trend has formed with median sales price, and overall it is going up. Now, it is not keeping pace with last year. I want to make that point. But if we look at week over week, that's a slight incline upward. To me, this makes me worry. This makes me worry that is fear of missing out really going to infect consumers again? Even with all of the data and red flags and insane mortgage payments, do people really still have fear of missing out, y'all? What? Anyways, so that's up week over week. Just want to let you know, new average median sales price was $370,625. That's still down year over year. Here's also something that worries me. I call this the Johnny Fly chart. Okay, this is what Johnny's watching a lot. This is the median asking price. Median asking price leads median sales price. Okay, it's keeping pace with last year. It's actually over this time last year by 0.5%. So what this is telling us is sellers want what they got last year. And it also tells us not only do they want what people got last year, they're listing their house for what people got last year. Now, we're paying roughly only 2.7% lower, which I think is crazy with everything that we have. But you guys, look at that. Median asking price is keeping pace with last year. In fact, it is over, and the week over week indication is upward. So again, do you think the Fed should pivot right now? Do y'all think here's the mortgage payments? We went over that. Pending sales down as well, 15.8%. So sales are only down 18%. This is crazy. Now, this is good. This is new listings coming to the market. Now, normally we want this to go straight up. Now, here's the beautiful thing. It is week over week, went straight up. But it's still historically low. That's what I'm saying. To pay attention to the trajectory of the trends is important to get an indication of where we're headed. Okay, but those trends can change. So, but nevertheless, new listings of homes is appearing to have a sharp upward trajectory. Problem is, you guys, we're still historically low. Really surprising how low, actually. But again, that's week over week that did shoot up. Okay, boom, boom, boom. This is not really okay. Look at this. This is also what I've been paying attention to. This is sad. This makes me sad. Look at what we started at the beginning of the year. We started at 4.5. Look at it. We were on our way. Look, and this brings me back to the banking bailout. Look at, we started the year out crashing. We started the year out like the housing market was resetting. Like, yeah, I'm on the phone with like a couple of viewers. I'm like, yeah, the banking failure. We finally were going to win. But they bailed them out instead. And look at what happened almost immediately. Okay. Almost immediately. Look, end of February, almost immediately after the bank bailouts, people started buying again. Supply started tanking. Look at that. Okay. This is why I'm saying what I'm saying. Now, this is down week over week. It's okay. It's 2.6 months. We want over 6 months. Consumers. So right now, it went down. It's going down about 0.1 months for the last, 6 weeks. All right. So that's kind of a bummer. Let's see what else we got here. Days on market is going down. We want this to go up. Okay, it's still over 2021 and 2022. And what that represents is a rude awakening for sellers. Okay, because here, make no mistake, sellers aren't getting everything they want. Just saying. But the nice houses seem to be. Let's keep going. This is also a leading indicator. Okay, this is a leading indicator of median asking price. Okay, or median asking price, which is listings that have price cuts. This is really going to tell us how unaffordability is affecting sellers. The good thing is week over week, it's up. We're at 5%. Again, you guys can see historically, we're like, what is this? Double where we're at normally this time of year, which means double the amount of people are dropping the listing prices on their houses. The thing is, guys, is this would be much higher if consumers would just stay united and paused. If we could just all work together here and pause and let the housing market recover, I think we would be in such a better place, Okay, so average home sold so almost all homes are selling for their list price. Isn't that insane to you guys? 99.4. Unreal. And look at demand. So here's the thing, a lot of lagging indicators, but demand appears to be tapering out. Do y'all think that demand may be tapering out because excess savings is running out and unaffordability has had its like historical high? Do y'all think that may be why it's balancing out? Because the whole banking failure and the red flags in the economy is not enough, right? I mean, and can you guys really blame them? I mean, if you're worried about the economy and that's not why you're buying, and then a banking crisis happens, and then the federal government bails them out over the weekend, do you blame them? Right? And I talked to a lot of viewers. They're like, Travis, they're just going to bail people out. They're just going to bail people out. I don't think they can. I'm just saying, except the elites, right? Anyways, let's keep going. All right, that looks like that's it, y'all. That's it. That's all I got. That is all I have for y'all. That is this morning's video. Definitely appreciate you guys. I have all of my timestamps on here. You guys go ahead and reference this information. What's going on, Mark? I hope this was good, you guys. I try to give you guys kind of just an overall, and that's what I'll do in my live videos in the morning. I'm going to try to give you guys on all of my live videos a really in-depth, look at things. Now, my evening videos is going to be, different. So my evening videos is going to focus on one thing. This evening's video is going to be on what happens if the federal government does not raise the debt ceiling. Okay, maybe it's wishful thinking. It may be wishful thinking, but that's this evening's video. We're going to dig into an article. Zillow's kind of leading the way, and we're going to ask ourselves what happens if they don't raise that ceiling. And I'm going to tell you guys right now what happens. We win. Because the reality is we need our government to stop spending money. They're like children spending money. Like, stop spending money, government. I'm just saying. Sorry. All right, so you guys, I'm going to call it a day, but if you guys have questions, let me answer some questions if you all have it for about 10 minutes. So, boom, boom. Cindy, appreciate you. Thank you, JP. Thank you. Tony, appreciate you. Elijah. Let's see here. All right, let's see what this guy has to say. So we got a hater here. Okay. Not great info. Coastal and Ventura. Using data to provide an opinion is not evidence. You read then evidence, then making, you read then evidence and make an opinion. I don't understand. I mean, I don't understand this guy. Obviously he's a realtor, and the thing is, guys, like I don't even get upset at realtors anymore because I know they're struggling and I know they're suffering and I know they just want to sell you. And the reality is, guys, their job is to sell you to buy a house. That's what they do. And a lot of them are really good at it. And the crazy thing is like in their broker meetings, they all say the same things, right? Just buy now, you're going to get trapped renting. You could just refinance later. Let me know if you agree with that. Coastal and Ventura. Do you agree, living Coastal and Ventura, that they could just refinance later? Let me know. Let me know. Let me know if you agree. All right, let's see what else here. Okay, any questions, guys? Okay, here we go. Here we go. Okay, so selling and buying. Should we stay in our current home or sell it now? When would be a better time to sell and buy? This is really hard. This is really, really hard. You know what else is depressing? Real quick, back to the realtor thing. It's not only depressing that these toxic cheerleaders are just fuming out like over optimism and reckless enthusiasm. The other sad thing is people actually believe them. They don't even, half these people don't even have college educations. You guys, half the realtors are pizza delivery men. I'm just saying, come up with something original. But here's the thing, really looking at this question, it really depends on your situation. It depends on what you can do after you sell, right? And it also depends on like your cash flow. Like, do you have a really low interest rate right now? It really depends. I believe probably the later we go on into the years, it's probably going to be harder to sell your house. So if you're considering selling your house and you can do something with the money or improve your quality of life, I don't necessarily think that's going to be a bad thing. But here's the thing, and I get this question a lot. People ask me, I see your comments. I know he's desperate for, all of the trolls are desperate for information, you guys. They want clout so bad. And the thing is like, if you guys want attention so bad, start telling the truth and start educating yourself enough to have a real opinion. Right now, they're just spewing cheerleading. They're just spewing it. It's just, they're like parrots. There's all this like little birds flocking together. Here's the thing. People ask me, Travis, if you believe there's a crash, then just sell. Why don't you just sell your house, right? The reason I converted my primary residence to a rental is I have a 2.375 and 45% in equity, and I worked 9 years to get an asset. So I prefer not to sell it. Now, would I sell it? If home values keep going up, I would definitely consider selling my house because it's just overvalued, and I will cash in. I'm gonna be honest with you. I'm considering cashing in because home values are potentially going to go up. I don't think it's going to continue, but the thing is, guys, this is an asset and I'm cash flowing, and my mortgage payment, listen, and here's why I'm not selling my house right now. I'm cash flowing. My mortgage payment and property taxes are sky high in Texas. My mortgage payment is only $2,000, and the loan in my house is worth about $400,000. If I were to buy that same house today, my mortgage payment would be $3,500. I'm just saying. But I'm not going to sell it. I mean, it's possible I'll sell it, but I just don't want to. I just don't want to. You guys, I think. Damien, I agree with your opinion, but don't worry, guys. It's just his opinion. Don't be upset. Let's see here, you guys. I'm going to take this last question. Real big viewers right here, Sean and Wendy. You guys, I really appreciate you guys from the very beginning. And then I'm gonna get out of here. It's hiding my face a little bit. I'm trying to hide from the haters. Don't hate on me, haters. Don't hate on me. Go figure things out and go, like learn, right? Why do haters even watch? Anyways, it's just the whole thing is weird. Question: can you touch a little bit on commercial and what is happening? Please tell your wife Happy Mother's Day. Thank you so much. Red heart shape. Okay, commercial real estate. So, biggest thing with commercial real estate, so when the defaults continue to happen, first of all, in commercial real estate, property values are going down. But a total collapse in commercial real estate, number one, what that's going to do is tightening lending standards. Number two, what it's going to do is going to put more banks out of business. Number three, what it's going to do is going to basically curve more investor demand. Okay, curve it like to where they're not buying new homes. So, if a total collapse in commercial real estate happens, it's going to be bad for the housing market. Just like if the debt ceiling is not like raised, it will be bad for that. To me, the bad is the good. But commercial real estate is commercial real estate. Residential is residential, but it all is intertwined through the banking system, right? A lot of it's the banking system and things of that nature. So if that goes down, y'all, it's gonna cripple the banking system, and the banking system is needed for the entire economy, including the housing market. And that's really what I see here. Okay, let's see here. All right, you guys, I am Sean. Appreciate you. Dude, you only get one time up on my screen. I'm not going to put the troll up here again. I mean, look at how desperate he is. Like, why are you still talking, bro? Like, all you're doing is hating. Why do you come places to hate? I don't get it. Dude, go out there, go love someone, buy someone a cup of coffee, and bark up someone else's tree, man. We're all closed here for nonsense. I'm just saying. But you guys, regardless, I really appreciate you participating. Even that realtor, thank you for at least commenting, man, because people need to say what toxicity, they need to see the toxic cheerleading. So thank you for showing them. Appreciate that. But other than that, you guys, really appreciate you. Everything is bookmarked. From the bottom of my heart, I wish you the best of luck. Make your own decision up. Don't listen to me. Don't listen to realtors. Watch the data. And please, for the love of all that's holy, use data to find the deal. Specifically, a market analysis. A market analysis will show you what things sold for in a subject property's local subdivision. And remember, real estate is about being local. So get with your realtors, do your market analysis, but please, you guys, do not use your emotions. And other than that, if you're out there investing in real estate, you already know, you guys, I wish you luck and I hope you win.